We are less than 24 hours until the last Fed decision of the year, with traders pricing in a near 90% chance that the committee cuts interest rates by 1/4 point tomorrow. For more on the market impact, let's bring in Fast Money friend and Richard Bernstein Advisors Deputy CIO Michael Contopoulos. Michael, great to see you.
Nice to see you, too.
Let's assume that there is a cut. What is the commentary going to be like coming out of that cut?
I think it's going to be hawkish. When you look at the data, I'm not entirely certain there's a real compelling reason to cut interest rates tomorrow. I think they're going to do it because the market is telling them to do it, and they very rarely disappoint the market. But there's enough dissent amongst FOMC committee members where I think Chair Powell is going to have to come out with his cut, but then kind of talk the market a little bit hawkish and say, listen, January is certainly not a sure thing. In fact, it likely won't happen. And, the balance of risks right now are pretty much tilting towards tighter versus market expectations rather than easier.
Yeah, so let's extrapolate a little into 2026 then, Michael. We've been talking about this for a while, but the assumption that the Fed will, in fact, be dovish and will deliver cuts next year because there will be a dovish chairperson put at the helm. But the fact of the matter is it's a very divided Federal Reserve right now, and we don't actually know what will happen. We don't know what will happen at the longer end. I'm just wondering, how you think about that and the possibility that the market could actually be disappointed because they might not get what they're pricing in right now at these valuations.
Yeah, I think much of the rally we've seen over the last 6 months or so, Melissa, has really been driven by liquidity and the expectation for the Federal Reserve to cut interest rates next year. And to your point, I don't think that's really sustainable. There's not a good reason to do so. If the next chairperson were to come in and cut interest rates and inflation remain around 3% or even go higher, if economic growth continues at sort of the level it is now, you're going to see meaningfully higher interest rates. And that's actually going to put a dent on some of these high valuation speculative excesses within the market. And that's not just, sort of AI. I'm talking about cryptocurrencies, credit spreads, meme stocks, SPACs. I mean, they're all liquidity driven investments off of expectations for an easier Fed. So from my perspective, this is one of the biggest risks to the broad markets at the moment, but also creates a lot of opportunity as well.